Hey there, this is Dr. Saburi, and welcome to a new part of my video series about financial markets and also about money and banking. In this series, I will try to connect the theory with the real world of finance and investment. In today's video, we will talk about the 5 core principles of money and banking. So the agenda for today is pretty short and sweet. I will introduce the 5 core principles and we will discuss each of them briefly, and that's about it. So let's jump into it. Now, the 5 core principles of the financial markets have to do with time, risk, information, markets, and stability. To be more concrete, the first principle we will discuss today is that time has value. And then the second principle that we will discuss is that risk requires compensation. If you take a risk, you would only do that if you get compensated through a higher expected return on your investment. The third one is that information is the basis for decisions. Principle number 4 is that markets determine prices and allocate resources. And then principle number 5 is that stability improves welfare. Okay, so without further ado, let's just jump into it. Now, principle number 1 is saying that time has value. Obviously, that you might think so. What we mean is that time affects the value of financial instruments. So, for example, if you invest your money in a savings account, or let's say in a CD, a certificate of deposit, the interest that you receive, the annual interest, is probably different depending on if you invest your money for half a year, 1 year, 2 years, 5 years, 10 years, or more. So typically, let's say a 10-year investment gives you a higher interest rate per year. So if you adjust already for the year, even per year, you get a higher interest rate for a 10-year CD, for example, than for a 3-month CD, typically. We will discuss in a later chapter some exceptions and why those exceptions happen. But for now, you should just know, obviously, that you need to have a higher compensation if you cannot access your money for a longer amount of time. In the meanwhile, you could just spend your money instead of investing it, and you could enjoy the consumption of your money. But because you cannot do that as a compensation, you are getting what is called interest. That interest itself is very sometimes controversial. We will discuss about that as well in other videos. Yeah, so that's why the longer you forego the consumption of your capital and you invest it, the more should be the compensation that you receive for that. That compensation is usually in form of interest. Interest is paid to compensate the lenders for the time the borrowers have their money. So far, so good. Now let's take a look into principle number 2. And principle number 2 is that risk requires compensation, right? So you have those very safe investments where, let's say, you put your money in a savings account and you receive your interest. You don't need to worry about anything. You don't have any sleepless nights, etc. And you have other investments where, for example, you put your money in the stocks market, or maybe you invest into a restaurant or other businesses that are way more risky because, for example, a virus might hit us and restaurants can't operate, or other things happen. Stock markets has turbulences, it goes up, it goes down, so you might lose money. You're taking a risk. Now, you would not take the risk if you wouldn't have a higher expected return, right? So you need a compensation in order to take that risk. Otherwise, why not just putting the money in the savings account and just enjoying the safe interest? So in a world of uncertainty, individuals will accept risk only if they are compensated. and the compensation comes in form of explicit payments. So essentially, you should expect the higher the risk, the higher the payment. In other words, the higher the risk that you're taking, the higher should be your expected return on investment. So expected return on investment, right? It's obviously not guaranteed because you have a risk. The next core principle is that information is the basis for decisions. Yeah, obviously before you make a decision, you gather some information. Well, how much information do you gather? It depends on, how big or how important is your decision. Are you deciding about what pen to buy? You just go to a store, you take a look at the 2-3 pens that they have, or 5-6, whatever, and you just take the one that you like. You think the price is fine, I like this pen, and you go out. You don't spend more time with it. Hopefully, if you do it, you're doing something wrong. So it's a $2-3 that you invest, a few dollars that you invest on a pen, so you don't waste too much time on that. It should be, however, otherwise, if you're buying, for example, real estate, purchasing a property is the biggest investment decision for most of the people. And it's usually somewhere between, at least here in Southern California, between a couple of $100,000 to a few $1,000,000. For that investment, you obviously do a lot more research. It's normal to search for months for a property. You read a lot of different reports. You hire a person who is checking the property, if the foundation is sound, if the construction itself is good, the building, if there is any big repairs needed. They check for termite. They check for possible environmental issues nearby. If the property is located very close to a mining field, for example, that could be an issue. Or if the property is close to an airport, or the travel routes of planes where you can have noise disturbance, and so on and so forth. You even maybe check out the neighbors. Are neighbors people who you get along with or not? Or other owners who are in that HOA, if you're buying a condo, and so on and so forth. So you do an intensive amount of research for buying a property, and obviously that makes sense because this is a huge investment. You do want to be pretty sure that you're doing a good investment and not doing a mistake and ruin your life with that. Now, principle number 4 is that markets determine prices and allocate resources. So as you know, in economic system, free markets, the market is the core of the economic system, right? The market price is determined by demand and supply, and the market price signalizes the value of the good that is being traded. As the price of a good increases relative to price of other goods and services, it means that more resources will be devoted to production of that. If you think of desk and chair, both are, let's say, made of wood, and a carpenter is building both of them. Now the price of the desk increases compared to the price of the chair. Now what happens is that more resources go towards the production of the desk versus the production of the chair, right? So more hours are devoted to production of the desk, and also more wood goes towards the production of the desk, and so on and so forth. So desk, as the price increases, sucks up more of the resources that are available in the economy towards the production of that desk, which makes sense in a way, because if we agree that higher price indicates a higher valuation for the consumers, consumers are willing to pay a higher price because that desk is worth to them, more than the chair, for example, then it does make sense that more resources are devoted towards the production of the desk. So markets in that way allocate resources. So how much of our resources should be devoted towards desk, and how much of our resources should be devoted towards the production of the chair. And the last principle is that stability improves welfare. Yeah, a stable economy reduces risk and improves everyone's welfare, right? This one is going hand in hand more with the second principle, where risk requires compensation. If you are in a stable economy, in a stable environment, then there is less risks faced any investment that you're taking. If there is less risk, you don't need to have a very high return on your investment as a compensation. You don't need to be compensated that much, because in a stable economy, in a stable environment, the risks are automatically reduced. At least certain risks are reduced, which reduces your overall risk. So more projects are worth being invested in because of the lower general level of risk. Now, if more projects are invested in, it means that there is a higher total investments, and that helps creating more jobs, more income, and more growth. So a stable economy grows therefore faster than an unstable one. As we will talk later in a later video, we will see that one of the main roles of the central banks is stabilizing the economy, as we see it in every recession. As we saw it, for example, during the Great Recession of the 2008-2009, as we saw it through the COVID-19 recession of 2020, and so on and so forth. So we will see a lot of interesting examples, and I will also try to always connect the little bit of theory that we learn here with some aspects of real world investment finance, personal finance, and so on. So I hope you enjoyed this video. Please subscribe for more videos like this, and until then, adios.